Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting. So the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome to The Big Picture. My name is Joe Cruey at Paradigm, in the weeds around everything crypto vol markets. Joined here by my macro all-star co-hosts, David Brickell, as well as Neil Patel and Nick Trileski, who run the crypto derivatives desk at DRW. This is going to be a really exciting conversation around something that we really haven't discussed on this channel before, and that is the CME Crypto Derivative offering. But before we begin, please hit that like and subscribe button. Really helps us as we continue to build this brand and this channel to become the go-to source for insights around crypto derivatives. But before we begin, Nick and Neil, if you guys can just give a quick background for our viewers, how you guys ended up at DRW and then ended up pivoting to pioneering this crypto derivative space.
Sure. Thanks for having us on. I'm one of many DRW lifers, been with the firm since 2006, got my start in rates, stayed on that desk for 14 years. And then when COVID hit, CME launched the Bitcoin futures and options, and we decided to get involved into the vol space, being that we already had the large OTC spot desk, so it was a natural fit. It was a lot of growing pains, as you can imagine. It was very slow to start. You have the CME OI chart, and you can see as recently as Q4 of last year, the open interest was only 400 million, and it really started to kind of uptick Q1 of this year as we saw a lot of people looking to onshore, and we saw a lot of people prefer the safety of a regulated and compliant exchange. So we saw the CME OI hit about 2 billion in Q1 and early Q2. But yeah, we've been in the crypto space for about 3 years now, and Nick and I are running the CME and bilateral trading desk.
Hey guys, yeah, so pretty similar to Neil. I started at DRW straight out of college. Was also on the rates desk, so did overnight trading, covering London hours, and did market making in rates. Yeah, with the pandemic, after CME launched their product, we started the crypto options market making desk. This space has been growing a lot and been focused on that ever since.
All right, awesome. Yeah, thanks for that intro, guys. So yeah, this is going to be a pretty informative conversation for our viewers around CME crypto derivatives. And to be honest, selfishly, myself and David as well, like, as naturally on Paradigm, our focus has kind of been around like other venues. So really grateful to have you guys here. And I think to start, kind of, Neil, as you alluded to, in 2023, we saw this significant surge in CME BTC futures and open interest, which I think logically, makes a lot of sense in a post FTX world where you're naturally going to see this capital flight to quality to trade against exchanges that aren't necessarily financial black boxes or, have something else to lose with, other product offerings of, going down in their crypto business. So looking at this chart, volumes in December were extremely low in the immediate aftermath of FTX. And of course, you had the seasonality effect as well, due to holidays. But as people came back to put money to work into the new year, especially due to this rally, the volumes in open and interest immediately covered. So I guess, can you speak a little bit more to this sort of flight to quality that you guys have seen in the crypto derivative space, not only to CME, but I mean, also into the bilateral business? Obviously, DRW has been around for a long time, has a stalwart balance sheet, has been, has a very solid reputation. So how are users, into 2023 really starting to think harder about managing their counterparty risk, and kind of what is your pitch around that?
Sure. So one of the main considerations to take into account with CME is it is completely agnostic of crypto. A lot of the offshore exchanges wouldn't exist if Bitcoin hit zero, whereas CME wouldn't bat an eye. So if you really need to hedge downside exposure, puts or short deltas, CME is the safest place to do it, and it is the venue of choice during any sort of crypto bear market. We saw front month basis flipped from positive 10% to negative 10% during the FTX crisis, as CME was the only safe place to actually put on short delta plays. So that was a catalyst for a lot of people preferring the CME. It's also just a regulated, compliant exchange, and they also recently lowered their margin, which helped kind of bring on some of the counterparties that thought the margin was a little bit too high. It's down to about 24%, so it's still higher than some of the offshore venues, but people are gladly willing to pay that, extra 10% margin to have the safety of the CME.
Right. Yeah, I think that makes sense. And other venues, we really don't see too much put buying, and I guess that might make sense, right? You buy a 5 delta, 10 delta put. Well, how confident can you be that you are going to get paid on that? And David, I'm going to bring you into the conversation here. You are our boots on the ground, so to speak, with prospective paradigm customers, and I'm curious to hear how you have seen your prospecting conversations evolve. Like, I would imagine in the FTX aftermath, a lot of questions around CME as counterparty risk came into greater focus. And David, now that we're well into Q2, like, would you say that interest has continued to be sustained?
Yeah, I think so. I mean, to Neil's point, I think post FTX, everyone was looking and thinking, deeply about counterparty risk, and obviously CME is a place to kind of trade safely. The big drawback has been around margin, which in many cases was prohibitive, and then also the tech connectivity as well. When people are set up on other venues, not always easy to pivot. But yeah, I think definitely, we're still in a world where counterparty risk is pretty key to people. So looking at either other venues like CME or even, around other kind of ways of managing that counterparty risk. I definitely feel if you look at some of the sort of larger institutions and particularly those from TradFi moving into the space, CME is definitely something that they're kind of keen on and looking at, and it kind of, they've got the economies of scale and scope as well that integrates quite nicely into their like current business models, and they get the kind of some of the cross margining benefits from that as well. So I mean, and actually I was interested to ask from you, Neil, like over this year, have you seen the kind of makeup of the sort of client base that's sort of trading with you guys via CME change much at all?
Yeah, so some of the crypto native funds that were originally trading offshore have had internal dialogue where they needed to trade on a regulated and compliant exchange that that does some sort of KYC AML compliance. So we've seen US-based crypto funds essentially prefer that venue, and some of them make the switch over. A lot of people were unaware of the type of liquidity on CME, and the liquidity has really improved over the last 6 to 12 months. You can see 1 year out options 2 to 3 vols wide for good size, so similar to what other venues are offering. And then, like I mentioned earlier, the downside buyer, and we're not talking about 25 delta puts, we're talking about end of the world puts, 10K puts, 15K puts. If you want to buy those, the CME is probably the only venue where you can feel comfortable buying those. So we see a big premium. Usually the vol surface is about 2 to 3 vols higher on CME relative to other venues. But on the put wing, you could see 10 to 20 vol premium on some of those low delta puts, because it really is the only place to safely hedge downside risk.
Yeah, that's interesting, especially you have, I guess, this, disparity in the vol pricing on the downside between, because this is the venue that you go to if you need tail risk. I would imagine that also presents, an opportunity for underwriters as well, where, potentially you guys, have a position where you can, you guys can facilitate those, and pretty competitively, kind of just looking at it from a perspective like, okay, if we're down there, I don't mind getting long down there.
Yeah.
Yeah,
for put sellers, it's definitely the best place to go because of that premium. We think on offshore venues, the put skew doesn't kind of reflect reality because the demand isn't there to kind of put it into place. So we don't see we don't see that the demand is going to change. It's going to be on CME, and that premium, I would say on average, it's probably about 5 to 10 vols for that 5 delta put area. It's going to kind of stay in that range.
Wow, interesting. And
alternatively, oh yeah, no, it's fine. Alternatively, on the top side, so for calls, you do see most of the supply enter the market on offshore venues because of the margining reasons that you talked about before. So when call overriders need to sell calls, they generally go to offshore venues because they can actually margin in native currency, and that's just something that the CME doesn't offer as a benefit, because you have to margin in dollars, and it's expensive for firms that have quantities of ETH or BTC to borrow dollars to sell calls on top of that. So we expect that to kind of change over the next coming years, because recently there was a CFTC declaration that CBOE Digital was granted margin on BTC and ETH futures. So margin in terms of posting underlying coin with a custodian to sell BTC and ETH futures. So eventually, hopefully that flows into options, and we can see some of the call overwriting flow arrive on the CME as well.
Right. And in terms of the main audience for that, my impression would be perhaps the onshore miners who look at sort of yield enhancement strategies. But can we talk a little bit more about, I guess, miners in general, and I guess this existing community of CME derivative users, not just the ones that have kind of capitulated a little bit and moved some risk off of other exchanges onto CME, but have you guys been seeing miners for example, realizing they need to get their act together and actually sell forwards to hedge their exposure if they want to reduce the cost of capital of their businesses? Or I would also expect maybe some traditional macro hedge funds coming to the CME, either for the levered delta exposure or some of the basis plays that you guys are talking about. But curious to hear about that existing customer base.
Yeah. So for miners, we haven't seen too many miners arrive on the CME. And it does make sense, especially in these kind of conditions when hash rate continues to increase. So it really pushes the pressure on margins as the price is kind of low. So that's something that we have been continuing to expect, but haven't seen a lot of, especially in the option space. In the future space, it's possible, especially if they just go through a broker to hedge futures against their production. But then we saw much more of the latter, where it's macro hedge funds or hedge funds in general. Maybe some of them are dipping their toes into being crypto hedge funds, have been arriving on the CME and putting on either highly levered beta plays or just trying to trade macro risk around BTC and ETH. And at the same time, we also seen some of the vol premia selling as well. There have been new participants that have been selling vol premium and BTC and ETH on the CME, similar to how other asset classes, how it's done in other asset classes where they just come in and sell strangles. So I've seen a bit of both.
And to add to that, for miners and underwriters, margining, it all comes down to margining. And if they can't margin in coins, most of them are dollar light, so CME might not make sense for them. So that's why we see the vol surface significantly lower on exchanges where you can margin in coin, or on bilateral where you can margin in coin, versus the CME, because most of the natural vol sellers need to be able to post coins instead of dollars.
Got it. So you would say that most of the onshore miners are, trading in bilaterally because of this.
Yeah, they definitely have a preference towards bilateral versus CME.
Right. That makes sense. So, elephant in the room, news flow last couple of days, which we don't really need to dive into here, but in light of kind of the recent developments that we've seen with other onshore exchanges, what do you guys see? Do you guys foresee institutions kind of taking, another step back to evaluate their options? And when do we see this, it's the $1 million question, this next wave of traditional institutional adoption?
Well, the beauty of the CME is they don't touch any coins. They have the reference rate, the futures are financially settled, the options settle into the futures. So the CME doesn't touch any coins. So they are a little bit safer than other venues. In terms of the SEC versus Coinbase lawsuit yesterday, very unfortunate for the industry. You know, Coinbase has been arguably the most compliant exchange in crypto by far. And to see them target that exchange is unfortunate and bad for the space. It's just bad for onboarding new users. And we continue to see a lot of just crypto native firms decide to essentially be based offshore. But we don't think it will have a significant effect on the CME in the short term.
I think it's interesting you say that, Neil, and so Joe, going back to earlier, the question around, you know, conversations with clients. I think one of the things that's really struck me since, particularly since FTX, and in terms of institutional adoption, is I kind of think people understand that what happened around FTX was a failure of a third party, and a bad actor within the space. I think people kind of get the value proposition for Bitcoin and sort of crypto generally. And it's all now about, it is about counterparty risk and understanding exactly the nature of those risks and where they are. So I think when people keep talking to me about, and conversations we have around, you know, what's going to be the effect of, you know, SEC, Coinbase, I don't think it's this, oh shit, that's the end of crypto then. I think, again, it just drives the, right, okay, well, what's the solution? And that's one of the things that's actually, you know, brought me a lot of sort of optimism around this space, in that the actual push has been, okay, well, where do we trade, or what are the solutions to this? And obviously CME would be one of those. But I think people kind of get it now. People kind of get the value proposition. We just need the right infrastructure and the right, I guess, regulatory frameworks within which to trade and be comfortable with trading.
Yeah, and I think that's coming over the years as more firms develop custody solutions, and more you know, well-known firms like Fidelity build out their custodian solutions, partner up with exchanges, hook up, you know, margin. You know, as this infrastructure and TradFi gets built, it'll enable more trusted venues to kind of, you know, move value and allow hedging, allow trading in general. So I think that's something that we're looking forward to and looking to support, and, you know, hoping that the industry, you know, prevails until then. So.
Right. That makes sense. Definitely feels like, you know, especially with the range-bound price action that we've seen. I mean, at least we've had some vol the past couple of days, but, you know, it could be a little bit more of a slow burn until we kind of see, you know, this breakout of the range and hopefully to the upside. And, you know, David, I know you have some thoughts on this, you know, given macro developments of the past couple of days or so. So do you want to get into it?
Yeah. I mean, happy to talk about that. I mean, yeah, it's funny because I've been quite bearish sort of crypto and risk, I guess, broadly over the last few weeks, anticipating this liquidity drain with the debt ceiling lift. We've been talking about that for a while now on this show, and it feels now like the world and its dogs talking about this liquidity drain. Oh, sorry, did I cut out there? Can you hear me? Am I back?
Yeah, you're back now. Yeah, to start over.
Yeah, so I've been talking for a while about this liquidity drain, and that we expect once the debt ceiling gets lifted, and that was making me pretty sort of bearish, I guess, for crypto in the short term, given we know particularly Bitcoin's a liquidity junkie. It feels now like it's quite a common narrative out there. I'm surprised, you know, Uber drivers haven't been talking about this liquidity drain, because everyone's kind of talking about it. But the irony is, you know, as we kind of, there's two aspects to that, I guess, in terms of I think there's a mechanical aspect. I do think liquidity and how it sort of funnels its way through the financial system, that you know, mechanically can sort of drag us lower if we suck that out. But also there's quite a reflexive aspect as well, and I think particularly as it pertains to crypto. And I'm kind of thinking now, like, if that is such a common story, maybe the impact of that reflexivity is kind of diminished. And I certainly feel that's why Bitcoin hasn't joined in the tech party that we've seen over the last few weeks. Because if you're looking at NASDAQ, you're kind of thinking Bitcoin should be ramping up. and yet we haven't joined in that. And I think it's in anticipation of this liquidity drain. So there's part of me that's thinking that maybe we see a sort of buy the rumor, sell the fact type redux in terms of how that's going to pan out. This chart we got up here, net dollar liquidity, I think this is a one to watch. As you can see, actually, the liquidity has actually been climbing over the last sort of month or so. And that's been a function of the quantitative tightening being offset by the TGA drawdown. Now, obviously, the big worry now is that,
Hey, David, can I just stop you for a second? It seems like somebody...
Yeah, Neil, I think it's your Slack.
Okay.
Yeah, I saw your message, Neil.
Okay.
Yeah, it's just going.
Yeah,
it's just going
yeah,
up
it's
right
just-
now.
yeah.
So
sorry. Okay. That all good?
all good.
Yeah.
Go on, David. Sorry. Well,
Yeah,
we'll just cut it out. Cut it out. It's easy.
Yeah, so the looking at that chart and liquidity, dollar liquidity has actually been improving over the last sort of few weeks as the TGA drawdown has been offsetting the quantitative tightening. Now the worry is that green line in the bottom channel absolutely collapses as they rebuild the TGA, but there are potential offsets to that. So I mean, we've already had like 170 billion issued this week in bills. That's kind of been digested okay, and the potential, the more that issuance is via bills, the more digestible that is, and potentially is offset by the reverse repo that's parked at the Fed. So it's going to be key for me to keep an eye on that chart there to see, does that green line, does the dollar liquidity absolutely collapse, in which case that's going to weigh quite heavily on Bitcoin. But there are offsets, and from a global liquidity perspective, there's offsets, and one of those that I'm looking at is China. China seems to be struggling now with a slowdown. Obviously, the currency is under a lot of pressure right now, and interestingly, they're not intervening to slow that currency depreciation. So it kind of tells me that China is quite worried about this slowdown. We had trade data today, which was pretty awful, declining exports, declining imports. So sort of China feels like they want the currency weaker to export their way out, and likely are priming the liquidity pump. PBOC putting some pressure on banks to cut lending rates. So we might well have, for all this fear about liquidity drain, pretty big offsets, be it from the US itself, if it's all bill issuance and the RRP actually funds some of this, and then also the potential for China to come in. And then the other chart, Joe, I was looking at earlier, and we were discussing is the move index. So when I think as well about things that are going to drive liquidity, which is quite a broad thing to try and measure, the move index. So this is the index of bond volatility. Now this is pretty important in terms of the more volatile sort of bonds are and treasuries are, the more difficult it is to take leverage and what have you. So bond volatility coming lower is actually pretty good for actually greasing the sort of wheels of the system and allowing leverage, and which also allow liquidity. So I'm looking at this, and this for me sort of looks pretty good for risk actually. So if you see the move index coming lower, it tends to augur pretty well for risk. The VIX, as we've seen, is what, on a 13 handle or something now. So for all this, it's insane. I mean, partly it feels like there's just this kind of general apathy in markets, even though Nasdaq's been sort of pumping away. But look, the sort of broad risk environment into this liquidity drain looks pretty good. Now, again, just mechanically, does it start to weigh over the coming weeks? I'm just wondering if, given how anticipated it is, it becomes a bit of a damp squib, and given these offsets, that actually we could be setting ourselves up now for a ramp to the upside. And then in light of the issues we've seen this week with the SEC and around Coinbase and Binance, you kind of really feel that we should have sold off more heavily, and we haven't. And we've been sort of in this range for Bitcoin and ETH for some time now. And the flush out that we saw, particularly on the Binance news, was, from what we're used to historically, was pretty weak, I thought. And I think that's partly reflective of the lack of leverage in the system. I don't think no one's leveraged long. I think position generally is pretty light. I think as well, given some of the issues with offshore exchanges, it's a lot more difficult to short these markets now. So when I think of past liquidation periods, it's come because there's been a lot of leverage in the system that's been absolutely flushed out, and B, you've had false liquidations with bankruptcies and what have you, and people that just have to sell their Bitcoin as they're kind of coming out of business. So in the absence of that, it's not obvious to me what actually sort of drives us, materially lower. And I actually think it looks quite constructive.
Yeah, I think that makes sense. Yeah, I mean, like, even I'm just looking at the top part of this chart, and it's like, damn, looks like a pretty nasty head and shoulders pattern. And one metric that I kind of follow closely is the 200-week moving average, which is around like 26,100, and I think we've tested it. You kind of see this range here. Here where we kind of tested that, 3 or 4 separate times, where it was just like, damn, if we kind of break below, the neckline was kind of right at this 200-week moving average. And if we broke lower, well, we could fill the gap all the way back down to 22, 21. But the fact that, even yesterday, we're down to 25,700 or so, and then we just kind of really bounced through it again. It kind of seems like we're in a place in this market where, like, how much bad news has crypto had, over the past few months? Yet, look at the price. Right. And it seems like every new piece of news flow that is negative for the space that comes in is just having a more muted reaction. So for me, like, that's a pretty strong bullish signal there. But like Nick, Neil, curious to kind of hear what you guys think around the more like medium term, short to medium term trajectory. Are we going to stay range bound, or is there a possibility?
Also as well, just as you go to answer that as well, and perhaps to tie in with that, what I'd be interested in is because over the last couple of days, we've not seen a material rush to put on downside, in light of those news. Now, it could be the factors we mentioned earlier in terms of, the reasons why people might not do that on offshore exchanges. So just interested as well whether, you actually saw a significant pickup in downside interest over the last couple of days.
Sure. Yeah, I'll try to address that. So I think, well, to start, you're mentioning that, like, we, given how much NASDAQ is up and how rates are doing, we kind of expected, if you saw someone did like a model where, they just used like NASDAQ, gold, and rates to kind of predict where Bitcoin should be as like a 4-factor model. So like that would have indicated that Bitcoin should have been higher, but right now it's kind of firmly below 30K. Not gonna really say any opinions on that, but that's definitely part of the reason. Part of the reason that has to do with that is obviously all the regulatory overhead that has been coming out this year. That combined with like supply from everyone keeps talking about the GOX supply or the announced U.S. Marshal Service supply as well. So people are being cautious. There is not a lot of leverage that we see in the system. Like there's, vol is very low. There's a lot of call overwriting going on. It's just like a natural tendency of risk markets. I mean, NASDAQ vol was around like 33 at the beginning of the year. NASDAQ is now up 30%, and the implied vol there is like 18 right now. Similar topic with Bitcoin and ETH. They're both up like 50, 60% on the year. And their implied vol is like at all-time lows, lower than it was at any point during the bull market. That's just kind of the nature of risk markets, and naturally Bitcoin and ETH are still risk assets. So when the assets go up that much, that leads to a lot of people who are long to sell calls to overwrite it, and then the natural risk is to the downside. So we have seen some people take stabs at this implied vol, here and there, but it's still pretty muted because I think people have been kind of demoralized by how tight this range has been. So no one is willing to really stick their neck out there, but small tactical plays here and there potentially, but yeah, nothing too inspiring.
Yeah, that makes sense. I mean, even what we're seeing is like, I mean, we're not really seeing those big BTC upside call buying that we were seeing earlier in the year, but rather kind of like smaller sort of tactical plays where we see this like crazy spot down, vol down. Like, I mean, even 2 days ago, right, when BTC was down like 5 or 6%, right? Like the August, fixed strikes were like lower, right? It's like it's just pretty crazy, right? So we're kind of, what we've been seeing is kind of like, the smaller sort of tactical plays where it's just like, damn, vol is so low, that's just gonna, delta play to top of the range, back to like 28, 29, but like nothing sexy or exciting, beyond that. How about you, Neil?
Yeah, to talk about the price action a bit, I think what was the catalyst for BTC from 20K to up to 31K was the regional banking crisis. We saw big rallies right after, Silicon Valley Bank and Silvergate, and there was a bit of diminishing returns. And it was basically the first time ever that Bitcoin had an inverse relationship with the regional bank ETF, KRE. That has flipped back to positive. So in the end, Bitcoin is a risk asset and it is going to correlate with the broader market. So I think that regional banking story is basically over, and you're not seeing banking crises lead to Bitcoin rallies anymore. In terms of the vol reaction, I think the underwriter supply has just overwhelmed market makers. So there's very little room for appreciation. They're kind of selling options at mid or on the first uptick just to kind of lighten their theta bill, and doesn't have room to breathe. It doesn't have room to grow. The underwriter flow is just the largest flow in the space. So that's been a reason for not having any sort of vol reaction on this move, but surprising to us nonetheless.
I think as well, like when I think of the macro, and not to hammer this point too much, but we are in this change in macro regime, where we're going from this sharp Fed tightening cycle to now the pause and eventually the cuts. But we've gone from a pause to now skip, and we're just unable to really embrace a new macro regime quite fully yet. I think the market's comfortable with that. We're no longer in this aggressive hike cycle and it's coming to an end, but we've just got no clarity over when that end hits. I think if I look back, we came into the new year with the market starting to price the end of the hike cycle, started to price some aggressive cuts into the curve as well. And then the data's kind of stayed resilient. The Fed have kind of, we're going to pause, now we're going to skip. So no one's been able to embrace a new regime. And I just think we're in this kind of no man's land, as we say transition from one regime to the next. So my assumption is that we are going to start to see the data start to sort of fall away, inflation starts to fall away, so that the Fed sort of fully go pause, and then the markets can then start to play that and know the regime we're in. Right now, we're just in this uncertain, are we going to see more hikes? Are we not? And the market doesn't really know what to do with it. And every conversation I have with clients at the moment, they're just really lacking conviction in and across asset as well, not just within crypto. Some of the macro guys, not sure, where this kind of goes, or they kind of feel, okay, we're moving towards this pause. We're more bullish, say the top side in Bitcoin. It's just about timing that. When's go time for the next leg higher? And now it kind of becomes, all right, it's Q3 or it's Q4, and it just keeps getting pushed out. And meantime, if you're trying to put on these longs to play that, then you just kind of bleed in theta, and it becomes a painful trade to sit in.
Yeah. I mean, yeah, it's been really tough to nail this macro regime. It's everything got kind of tossed to the side with the banking crisis, and even right now, I mean, the markets are still pricing in potentially like one more rate hike in the summer. Inflation has been persistent. It's been sticky in certain places, and in other places like commodities, it's like showing that it's actually coming down. So it's very difficult, for people I mean, even the employment numbers have been coming out. Like the economists have not been able to nail like, a downturn in employment. Every single employment announcement has been like a complete, whiff on their end. So I think it's just been a really tricky environment as this economy comes out of this like post-stimulus world. It's hard for people to, put on like a crazy risk play one way or the other, because, if another with another emergence of inflation, like we're gonna have to keep hiking, we might have to pause and wait for a while, or we might have to like start emergency cuts. Like no one knows what's gonna happen. So it's just like, it's the pricing is just kind of flatlined.
Yeah, for sure. I think as well, for me, that's the biggest risk to this market is that, ironically, if the data keeps coming in, or if the data comes in pretty strong and remains resilient and inflation higher, if we start pricing in a higher terminal Fed rate, I don't know, towards 7% or so, then I just think that's the thing that would really hit risk and probably Bitcoin and take us lower. I don't see that's not my base case, but I think for me that's the sort of biggest risk out there at the moment. That's going to like materially take us lower and unwind all the good work we've done throughout so far in 2023.
Yeah,
That won't help the banking crisis at all. A terminal rate of 7. So I think the Fed is definitely incentivized to pause for the next meeting. I think it's about a 30% chance of a hike at the next meeting, but they do not want to further worsen banks' balance sheets, which a rate hike would do so.
Yeah, and we're still seeing some pretty lumpy deposit outflows on an unadjusted basis. I don't actually know how you adjust deposit outflows. Surely outflows are outflows, but the adjusted outflows look okay, but actually on an unadjusted basis, we're still seeing constant deposit outflows. And that'll be particularly interesting given this treasury issuance. We'll see bank reserves fall quite heavily over the next few weeks. And then all of a sudden we could be back into more banking issues, because I don't think they've gone away, because the factors that drove the deposit outflows and this deposit walk, is the fact that Fed rates are simply too high for these markets to handle and for banks to handle. So the money's going to keep leaving in search of higher yields. Banks can't materially sort of jack up their deposit rates, otherwise they'll lose profitability. So I still think we've got those risks bubbling in the background, and it does feel a little bit like this calm before the storm. Everything in my sort of 20 years of experience trading, we do feel like a coiled spring at the moment in terms of volatility, and it's often surprising what sparks it, but there's certainly, we can see things out there that could spark some volatility over the next few weeks.
All right, awesome. Well, we are at the 37-minute mark, so I think we leave it at that. That was a super insightful conversation, especially around like the CME stuff that David and I are not necessarily touching every day, and I think for our viewers as well, kind of getting a sense of what traditional institutions are doing and how the flows there kind of compare to other venues is really just awesome insight. So, and as well as your macro takes, giving you guys, I think you guys are former rates guys, right?
Yeah.
Mm-hmm. Right. So right. So I mean, yeah, thanks for all the insights here. Really, really enjoyed the conversation, and we'll speak soon.